Welcome to the Time and Market Deep Dive. Just a quick reminder before we start, this is strictly for entertainment purposes, so please seek professional advice for any financial decisions.
Absolutely.
So imagine selling $111 billion worth of product in just 90 days.
It's a staggering number.
Right. You shatter every Wall Street estimate, you post this record-breaking quarter, you pull in almost $30 billion in pure net profit, and then, when the closing bell rings, your stock price does absolutely nothing.
Yeah, just a collective shrug from the market.
Exactly. So today, we are pointing our magnifying glass at ticker AAPL. We're breaking down Apple's Q2 fiscal year 2026 earnings report and really exploring why this historic financial victory lap is being, completely overshadowed by a massive behind-the-scenes bottleneck.
Yeah, because that flatline reaction from the market, it tells a much bigger story than just the headline numbers. We're basically looking at a snapshot of a company caught in this violent tug of war. On one side, consumer demand for the new iPhone 17 lineup is, and I'm quoting Tim Cook directly here, off the charts.
That's the charts, yeah.
But pulling in the exact opposite direction is a brutal supply chain squeeze. I mean, we are witnessing the ultimate hardware giant colliding with the physical realities of a global silicon shortage.
Driven by the whole AI boom, right?
Exactly. The artificial intelligence boom is just eating up everything.
Well, the disconnect between that demand and the actual numbers, that's the first major anomaly we really have to tackle, because the primary engine of this massive machine is still the iPhone.
Always has been.
Yeah. And Apple CFO, Kevin Parikh, confirmed on the call that the iPhone 17 family is officially the most popular lineup in the company's history.
Which is saying something for Apple.
Totally. And for those of you tracking the product mix at home, that includes, the standard 17, the Pro Max, the new 17, and that incredibly hyped iPhone Air.
Right, the Air was huge.
Yeah, plus they introduced the M4-powered iPad Air and the new MacBook Neo, which, by the way, actively pushed the Mac segment to an $8.4 billion beat. So the hardware is clearly a cultural hit.
Oh, without a doubt, people want the devices.
But, and here's the catch, the iPhone revenue came in at $56.99 billion, and analysts were expecting $57.21 billion.
Yeah, it's a slight miss, but
a miss nonetheless. So how does a company experience, off the charts demand for its flagship product and still fall short of revenue expectations?
Well, the gap between those two realities really just comes down to the mechanics of revenue recognition.
Okay, break that down for us.
So in corporate finance, especially for physical goods, demand does not equal fulfilled sales. You literally cannot recognize the revenue until the physical device is delivered to the customer.
Oh, right. So I could buy it online, but it doesn't count yet.
Exactly. You can have millions of people adding the iPhone 17 Pro to their digital shopping carts, right?
Yeah.
You can have lines wrapped around the physical stores,
Yeah.
But if you do not have the inventory to actually hand over the counter, well, that money does not exist on this quarter spreadsheet.
Wow. So Wall Street is reacting to a physical limitation.
Precisely. That $220 million gap between expected and actual iPhone revenue, that represents the money Apple basically left on the table simply because the assembly lines couldn't move fast enough.
Which feels, entirely out of character for them, doesn't it?
Much so.
Because Tim Cook built his entire legacy on supply chain mastery. He turned Apple's operations into the most efficient logistics machine on the planet.
He really did.
Yet, on this earnings call, he explicitly admitted a lack of, quote, flexibility in the supply chain at the moment.
Yeah, that was a very telling phrase.
So if demand isn't the problem, what is physically causing this traffic jam on the assembly line?
The root cause of this specific bottleneck is silicon. Apple is just being aggressively squeezed by the global AI chip war.
Okay, so how does that work mechanically?
Well, to understand it, we have to look at TSMC, the Taiwan Semiconductor Manufacturing Company. They fabricate Apple's A19 and A19 Pro chips.
Right, the brains of the new iPhones.
Exactly. And historically, Apple has been TSMC's undisputed apex client. They got first dibs on the most advanced manufacturing nodes.
But not anymore.
Not right now. Right now, TSMC's fabrication plants are completely overwhelmed because they are the exact same foundry that manufactures the massive AI chips the rest of the tech industry is desperately clamoring for.
Oh, wow.
Yeah, everyone needs these accelerators to build out their data centers.
So wait, Apple, the company that usually dictates terms to its suppliers and just monopolizes logistics, is basically an airline that just sold out every seat for the holidays?
Mm-hmm.
But they were stuck on the tarmac because a new mega carrier just bought up all the jet fuel.
That airline analogy is highly accurate. They are waiting in the same exact line for silicon as everyone else building cloud infrastructure.
That is wild.
And the constraint is not even limited to just the main A19 processors.
Really. What else is short?
Well, the earnings report and some of the analyst notes highlight increasing friction in acquiring RAM memory.
Oh, memory constraints too.
Yeah, and this memory constraint had a compounding impact from the first quarter right into this second quarter of 2026. In fact, analysts are already projecting that this RAM shortage could threaten the upcoming iPhone 18 lineup.
Wait, the 18? The one everyone is talking about for September?
Yep. If you follow the supply chain rumors, the expectation is a September launch for Apple's first foldable iPhone.
Right, the foldable.
And a foldable device, packed with complex new display tech and continuous background processes, that requires a massive amount of memory.
Oh, for sure. I mean, a device like that is essentially running two screens. It needs to seamlessly hand off apps between them. It's a memory-hungry beast.
It is. So this hardware constraint really reveals how the broader AI boom is causing intense collateral damage to traditional consumer electronics.
Apple is basically fighting a war of resource allocation.
Exactly. They have to secure enough specialized chips and memory for hundreds of millions of pocket-sized devices. Meanwhile, the foundries they rely on are dedicating increasingly massive resources to the hyperscalers building out the AI gold rush.
Well, so if the AI gold rush is eating Apple's supply chain, we really have to scrutinize what Apple is actually doing in the AI space themselves, right?
Oh, absolutely. Wall Street is heavily scrutinizing their internal AI strategy right now.
Because they're suffering the collateral damage of this industry-wide pivot. Let's look at Tim Cook's recent company-wide all-hands meeting.
Yeah, that was interesting.
He was emphatic, right? He stated Apple is making huge investments and is, quote, all in on AI. He even called it the most profound opportunity of our lifetime.
The internal rhetoric is definitely strong, and, there are tangible structural moves backing it up.
Like what?
Well, Cook highlighted the recent acquisition of an Israeli startup called QII. They specialize in advanced facial movement technology.
Okay, so building out the tech stack.
Right. And he pointed to the high engagement rates for their new visual intelligence features. Plus, he promised a significantly more personalized Siri launching later this year.
A better Siri.
Yeah.
Finally.
Yeah. Management is really trying to signal that AI is being woven into the fabric of the entire ecosystem rather than just existing as a standalone app.
Okay, but I have to play devil's advocate here because the consumer base is really losing patience.
Oh, for sure.
When you read the commentary from the McDaily news sources, I mean, the Apple faithful are restless. You have commenters dismissing Cook's statements as just empty CYA cover your assets attempts.
Right. People are very skeptical.
One user bluntly stated that Siri still remains mostly an idiot compared to Google and the other major large language models.
Yeah, that's a common sentiment.
And another pointed out the elephant in the room. Apple boasts about having the best silicon and software integration, but they don't seem to have their own foundational AI model that actually competes with the industry leaders. So if the user experience with their primary digital assistant still feels archaic, is Apple just, simply too late to the AI party?
Well, the skepticism from those users is completely valid if you evaluate Apple using the metrics of a cloud-based software company.
Okay, but we shouldn't do that.
No, because the analysis provided by Transcript IQ on the earnings call reveals that Apple is playing an entirely different architectural game.
How so?
The core of their strategy is not about building the absolute biggest, most parameter-heavy cloud-based LLM to compete directly with OpenAI or Google's server farms.
Right.
Apple's strategy is anchored heavily on on-device AI architecture.
Okay, explain the mechanical difference there for us. Why is on-device such a crucial strategic pivot compared to what the rest of the industry is doing up in the cloud?
Because it fundamentally changes the economics and the privacy of the technology. Look, most generative AI right now requires sending your query from your phone up to a massive energy-intensive server farm.
Right, it goes to the cloud.
The server processes the request, generates the answer, and sends it back. That costs the company money every single time you ask a question.
Wow, okay. I never thought about the cost per query like that.
It adds up fast.
Yeah.
So Apple is trying to run as much of that localized AI directly on the neural engine of the processor that's already sitting in your pocket or on your desk.
Oh, so they are basically offloading the compute cost onto the hardware the consumer already paid for.
Exactly. That is the financial benefit.
Sneaky, but brilliant. And what about the consumer?
For the consumer, it's a durable differentiator against Android alternatives because it inherently offers better privacy and lower latency.
Because your data never leaves the device.
Right. So from management's perspective, they don't need to invent the smartest cloud model in the world. Their ultimate moat is their 2.5 billion active devices.
1.5 billion? That is insane.
Right. They just need to deploy a highly capable localized AI seamlessly and privately to that captive audience.
Making it frictionless.
Exactly. If they make the iPhone the default, frictionless gateway for how average consumers interact with AI daily, they capture the value of the cycle without incurring the massive server costs.
Wow. That reframes the entire strategy. I mean, they didn't invent the MP3 player, they didn't invent the smartphone, and they aren't trying to invent the foundational LLM.
Nope. They are waiting to refine the deployment mechanism everyone actually wants to use.
But, while we wait to see if this personalized Siri actually delivers on that promise, or if the foldable iPhone 18 gets enough RAM to even function, there is a glaring question of cash.
There is always the question of cash.
How is a company generating a staggering $28 billion in operating cash flow in a single quarter while its primary hardware is bottlenecked by chip shortages?
Well, the mechanism keeping the cash flow moving at that volume is the services segment.
Ah, services.
Yeah. Looking at the breakdown, services beat expectations significantly, pulling in $30.98 billion this quarter alone.
$30 billion just from services.
Right. But the absolute most critical metric regarding services isn't the top-line gross revenue, it's the margin.
Okay.
The services segment operates at a massive 70+% gross margin.
Wait, we need to pause on that 70% figure because that just defies the physics of the tech hardware world.
It really does.
Like, when Apple sells you a physical titanium iPhone, they have to mine the materials, pay for the assembly, load it onto an ocean freighter, store it in a temperature-controlled warehouse, and then pay retail staff to hand it to you.
A huge logistical tale.
Right, so the margins on hardware are good, but they are physically bounded by reality. Services just operate under completely different physical laws.
They do. Because services represent things like Apple Care, iCloud storage subscriptions, Apple Music, and the App Store revenue cut.
Pure digital.
Exactly. Once the initial digital infrastructure and server capacity are established, the marginal cost of selling you an extra 50 gigabytes of iCloud storage or taking a 30% cut of an app purchase, it's practically zero.
It's basically free money for them at that point.
Yeah. And as management pointed out in the transcript IQ analysis, this mix shift towards services is structurally transforming the entire company's profitability profile quarter over quarter.
So they're getting more profitable even if they sell fewer physical phones.
Right, because they are seeing steadily higher attach rates, meaning more hardware buyers are immediately subscribing to Apple Care and iCloud the second they get the device.
So services is basically subsidizing the hardware traffic jam.
Exactly.
Even when the flashy physical products hit a speed bump at TSMC, Apple's ecosystem is functioning like this massive global subscription service, quietly printing high-margin cash in the background. It creates an incredible financial buffer.
A buffer that makes them highly resilient to volatile, cyclical swings in hardware upgrade cycles. And honestly, that resilience was heavily tested this quarter when you look at the geographic shifts in the earnings report.
Oh yeah, the macroeconomic gravity still applies to them somewhere.
Right. The Americas region actually missed expectations. They brought in $45.09 billion versus the expected $45.82 billion.
Yet looking across the map, Greater China actually beat expectations, coming in at $20.57 billion. And that is an incredibly complex market right now.
It is a vital beat. I mean, China is a fiercely contested market with intense local competition from domestic smartphone brands who are aggressively pushing their own AI features.
Right.
So beating expectations there demonstrates serious brand resilience in a very tough macroeconomic and competitive environment. But the geographic bright spot that management specifically highlighted on the call is India.
Yeah, the sources single India out as a standout growth market with record revenue. But it seems like India is playing a much more complex role for Apple than just, like, a new place to sell phones.
Oh, definitely. India is functioning as a dual engine for Apple's long-term strategy.
Okay, dual engine how?
Well, yes, it is a massive, growing consumer market where they are establishing a premium brand presence. But critically, it is increasingly the anchor of their manufacturing expansion.
Building the supply chain out there.
Right. By scaling up the localized assembly of iPhones in India, they're actively creating a physical supply chain hedge.
Mm.
They're decentralizing their reliance on any single region or geopolitical dynamic.
That makes total sense. Building the phones where they want to sell the phones reduces tariff exposure and shortens the logistics tail.
Precisely.
It's a structural pivot. They're trying to rebuild the flexibility that Tim Cook admitted they're currently lacking.
Yeah, they know they have to fix it.
And they clearly know they need to keep Wall Street patient while they navigate these hardware bottlenecks, expand in India, and build out their localized AI infrastructure. Because they unleashed a massive financial reward for investors this quarter to keep everyone happy. Apple authorized a staggering $100 billion share buyback program, and they increased their dividend to 27 cents per share.
That is a profound flex of corporate financial muscle. I mean, a $100 billion buyback does two things mechanically.
Walk us through it.
First, it artificially boosts the earnings per share by permanently reducing the total number of outstanding shares on the open market.
Right, smaller pie, bigger slices.
Exactly. And second, it signals absolute confidence to the investors. It is management's way of explicitly stating, we acknowledge the supply constraints and we are pouring capital into AI development, but our fundamental cash generation is so overwhelming that we can afford to buy back our own company while we execute this transition.
Yeah, that's a bold statement. So let's pull all these threads together. We opened with a paradox. $111.2 billion in record revenue, the most popular iPhone lineup in history, but a stock price that flatlined. The picture is much clearer now. We're watching a company in deep transition. The massive cash generation of the services division and the intense consumer demand are actively warring against the physical reality of TSMC chip constraints.
Exactly.
Apple is pivoting hard toward on-device AI architecture, but they're physically bottlenecked by the very AI data center boom they are trying to navigate.
And this dynamic brings up a really fascinating historical parallel, one that actually surfaced in the source commentary from a user analyzing the market.
Oh.
Yeah, think back to the 1849 gold rush in California. Hundreds of thousands of people rushed west, risking everything, spending all their capital to dig for gold.
Right, the classic boom.
But a fraction of them struck it rich, while the vast majority went completely bust. The people who made the most reliable, consistent, and durable wealth during that entire chaotic era were not the ones swinging the pickaxes.
It was Levi Strauss.
It was Levi Strauss. He did not dig for gold. He sold the durable denim jeans that every single miner fundamentally needed to participate in the rush.
Wow, okay.
And in 2026, we are in the absolute thick of the AI gold rush. Massive tech conglomerates are bleeding tens of billions of dollars in capital expenditures, fighting over server racks, hoarding GPUs, and trying to build the ultimate cloud-based large language model.
Yeah, it's an incredibly expensive arms race.
It is. And the path to actual consumer monetization remains highly volatile.
So Apple is basically opting out of the arms race.
They are actively avoiding that specific capital drain. They're not trying to build the biggest pickaxe. By leaning into their moat of 2.5 billion active devices, Apple is positioning itself as the Levi's of the AI gold rush.
That is such a cool way to look at it.
Right. Let the other companies spend billions to develop the underlying foundational models. Let them fight over cloud compute. Apple simply needs to own the platform, the digital genes, so to speak, that everyone relies on to access that AI.
I see.
If they seamlessly integrate these localized models into iOS and macOS, they get to monetize the AI revolution without having to bankrupt themselves building the foundational server architecture.
They aren't losing the AI war. They are just supplying the battlefield and charging a toll at the gate. So as you look at the device in your hand right now, ponder this. As the entire tech sector scrambles for silicon dominance and bleeds cash to build the smartest cloud, will Apple's famous walled garden be a barrier that isolates them from innovation? Or will it be the ultimate net that captures the profits of the AI revolution?
Something to think about.
Definitely. Thank you for joining us on this deep dive.